Today is Thursday, December 25th, 2025. Because it is Christmas Day, the New York Stock Exchange is closed for the holiday. D-Wave Quantum Inc., trading under the ticker symbol QBTS, finished its most recent active session on Wednesday, December 24th, at a closing price of $27.52 USD. This represented a fairly significant intraday decline of 1.60 USD, or approximately 5.49%. While most investors are enjoying their holiday break, those watching the quantum computing space are staring at a massive gap between the market's high-flying narrative and the cold, hard numbers on the balance sheet. You might think a stock that has rallied more than 230% throughout 2025 is a safe bet for continued dominance, but the reality is that D-Wave is currently walking a tightrope between being a legitimate industry pioneer and a victim of its own success. The expectation right now is that D-Wave has essentially won the race to commercialize quantum computing. After all, they are the only ones regularly announcing multi-million-dollar deals with governments and massive corporations for their annealing systems. But the reality is far more nuanced. While companies like NVIDIA stock and Tesla stock have built empires on hardware that is essentially the backbone of every modern industry, D-Wave's hardware is highly specialized. It excels at optimization, finding the best way to route delivery trucks or organize a factory floor. But it isn't the general-purpose quantum computer that some retail investors on a trading platform might think it is. This distinction is the core of the tension we are seeing in the price action as we close out December. Looking at the recent movement, QBTS has been a magnet for volatility. After peaking near 46.75 in mid-October, we have seen a series of lower highs and lower lows that have brought us down to this $27.52 level. This 35% pullback from the highs isn't just random market noise, it's a reaction to heavy insider selling and a shifting institutional perspective. Just days ago, we saw significant filings showing that top executives, including the CEO and CFO, have been trimming their positions. When leadership starts selling millions of dollars worth of shares after a triple-digit run, it naturally makes the self-investing community nervous. This institutional activity, where we see firms like Morgan Stanley and Bank of America holding large chunks but also observing these insider exits, suggests the easy money phase of the 2025 rally is over. If you look at your individual brokerage account and see D-Wave sitting there, you have to ask yourself if you're holding it for the technology or the momentum. The momentum has clearly stalled. Trading volumes have been erratic, often spiking on news about the upcoming CES 2026 showcase in January, only to fade as the market remembers the valuation. We are looking at a company with a market cap near $10 billion that generated only $3.7 million in revenue last quarter. That is a price-to-sales ratio that would make even the most aggressive tech bulls blush. Whether you use Interactive Brokers or Fidelity for your stock trading, these fundamental disconnects are hard to ignore. The story D-Wave tells is one of quantum supremacy for real-world problems. They recently completed the calibration of their Advantage 2 system in Alabama, making it operational for government tasks, specifically in national defense. This is a big deal because it moves quantum out of the laboratory and into the field. However, the market is currently struggling to price that potential. We are seeing a tug-of-war between the retail crowd on the Robinhood app, who are chasing the dream of a quantum future, and the more skeptical analysts who point out that the company is still losing hundreds of millions of dollars a year. This is the classic expectation versus reality setup. The expectation is a world where D-Wave solves the world's most complex problems tomorrow. The reality is a long, expensive path to even a single dollar of net profit. Sector momentum has been a tailwind for most of the year as quantum computing became the new it thing following the AI surge. But as we move into 2026, the market is becoming more discerning. It isn't enough to just be a quantum company anymore. You have to show a path to being a sustainable business. D-Wave has a massive cash pile right now, over $800 million, which gives them plenty of runway to innovate. But that cash came largely from the stock's massive run and subsequent capital raises. If the stock continues to slide, that source of funding becomes more expensive and less certain. This is why the price action at this $27.52 level is so critical. It sits right in the middle of a massive range, and the direction it breaks early next year will likely define its trajectory for the next 12 months. For those of you using online investing tools or Schwab Intelligent Portfolios to manage your tech exposure, you have to recognize that D-Wave is a high beta play. It moves much faster than the broader market, both on the way up and the way down. Institutional activity has shown some interesting developments lately, with some hedge funds actually increasing their stakes even as insiders sell. This suggests a rotation within the ownership base, moving from early venture-style holders to institutional growth funds that are willing to sit through the volatility in exchange for a seat at the table when quantum finally hits the mainstream. Let's pause here for a second and get some community feedback. Comment below how many shares of D-Wave you currently hold, or if you're waiting for a deeper pullback before starting a position. I'm curious to see if the sentiment here matches the bearish pressure we've seen on the charts over the last week. To understand why D-Wave is in this position, you have to look at what they actually do. They aren't building the same kind of quantum computers as Google or IBM. Those companies are focused on gate model systems, which are meant to be universal. D-Wave uses quantum annealing. Think of it like this. If a universal quantum computer is a Swiss Army knife that can do everything but is still very hard to build, D-Wave's machine is a high-powered industrial laser designed specifically for one task: optimization. Because their task is narrower, they have been able to scale up the number of qubits much faster than their competitors. Their current Advantage system has over 5,000 qubits, while universal systems are still struggling to break past a few hundred stable ones. This gave D-Wave a massive head start in commercial quantum computing, allowing them to sign deals with companies like MasterCard and various logistics firms. However, the reality that is starting to set in is that classical computers, the ones we use every day, are getting better at optimization too. New algorithms are allowing standard chips to compete with quantum annealing in many areas. This puts pressure on D-Wave to prove that their machines aren't just faster, but fundamentally better in a way that provides a massive return on investment for their clients. Their recent third-quarter report showed 100% revenue growth, which sounds great until you realize the base was very small. They went from nearly $2 million to $3.7 million. For a $10 billion company, that growth needs to accelerate significantly to justify the current stock price. Macroeconomic pressures are playing a role. With interest rates still being a central theme for 2026, speculative tech stocks are under the microscope. Investors are no longer willing to pay any price for future growth. They want to see operating leverage, which is a fancy way of saying they want to see the company's losses start to shrink as revenue grows. Right now, D-Wave's expenses are growing almost as fast as its sales because the research and development costs for quantum hardware are astronomical. Every time they want to build a better machine, they have to invent new materials and cooling systems that have never existed before. Looking ahead, the big catalyst on everyone's radar is CES 2026 in early January. D-Wave is expected to showcase real-world customer success stories and perhaps reveal more about their own gate model research. Yes, they are also trying to build a universal quantum computer on the side, which is a massive undertaking. If they can show a working prototype of a scalable gate model chip, it could reignite the rally. But if the presentation is just more of the same optimization talk we've heard for 2 years, the market might continue to de-risk. There is also the risk of the quantum bubble finally popping. We saw this with the dot-com era and more recently with the EV space. A revolutionary technology captures everyone's imagination, the stocks go parabolic, and then the reality of how hard it is to actually make money sets in. D-Wave is currently the poster child for this cycle in the quantum sector. If you are using Fidelity Wealth Management or looking for investment help from a professional, they would likely tell you that a position in QBTS should be a very small part of a diversified portfolio.